Good evening, traders, and welcome to today's session. Best trading approaches depending on market volatility. Chris and I will show you some tips and tricks regarding market volatility, how to handle it, how to use volatility stop losses. So some information might be also new to you, but also if you are a novice trader and you're watching the video from YouTube, well, this is something that you might profit from, something that can keep your account in a better shape if you're afraid of big volatility and if you don't know how to handle volatility. So before I begin, standard risk disclaimer explaining that CFDs and Forex trading are leveraged products and can result in losses that exceed your deposits. So this presentation and video is for informational and educational purposes only. And to get a corresponding information on charting conditions and any other detail, you should visit admiralmarketsglobal.com, set your country of residence, and contact an appropriate entity. This video is part of the globaluse.com website. So I will explain about volatility and momentum, why we need it, and then I will tell you different things about ATR indicator, ATR stops, our own indicator, our own trading system based on Heiken Ashi candlesticks. So you will find a lot of useful information in this webinar. So before we begin, well, let's say that the good example of volatility was yesterday Fed movement. It was a bit volatile, but well, you could see that I traded it live even before Fed. I hadn't closed my Australian dollar before the Fed. So my Australian dollar went in a stop loss. I lost only 1% of my account, but then I actually entered euro dollar around 0.745 by market order, and I was profit stop for some 25 pips again. So I will open probably a new order, making a swing position as we discussed on live trading webinar. But guys, if you know how to handle volatility, if you can enough of margin to actually cover up for some risk that you decide, it shouldn't be hard. Well, if you know, a lot of traders also asking me about dollar yen. I'm still long on dollar yen. Again, 1% of risk. Guys, you need to really, in order to be successful in trading, you need to understand the risk principle. If you start to trade with high risk, you might get higher profits, there is no doubt, but sooner or later you might be stopped out and lose a lot of in your account. So always heed to advice when you actually start to trade. Listen to what we have to say and you should be fine. So volatility in Forex is common, and I honestly like the volatility. When I started to trade, when I was a young trader, well, then I was a bit afraid because I didn't know much about volatility. My screening time was not that high. I hadn't had a, let's say, a big screening time to find out why price moves in such a way, why NFP is so important, why price tends to spike and reverse afterwards. So everything was confusing. But then, I mean, huge number of hours and screening time actually got me to this stage where I'm now, to really feel the market as the part of myself, to really feel the movement and to actually, well, although we can be wrong from time to time in our trading decisions, we should understand that volatility, no matter what you think, volatility is your friend. Okay, volatility simply measures jumps in price over a certain period of time. It measures overall price fluctuations, and without volatility we wouldn't, guys, it's really boring when you sit all day to make 10 pips, right? So when you need to sit all day and your trade is not going anywhere, well, basically you know that you will probably close that trade for some 10-15 pips because it's the setup. If the setup is not going anywhere, if you see that it's ranging, market is not going anywhere, well, you tend to close your trade. Volatility actually helps us. It gives us those jumps in price. If we are correct in prediction or with our trade entry where the market might go, sudden spike in volatility can suddenly boost profits. Well, if you remember today we had a GBP bank, it was actually bank rate bid rate decision, and it was a bit hawkish from BOE. Even one member of the board actually voted for a rate hike, and we saw a sudden spike in GBP dollar and GBP yen. They spiked like 100 pips instantly. So, well, you know, then I was thinking, okay, I didn't trade it, but my friend who is a full-time trader, he actually likes to trade those kind of volatile news, and we were actually talking on Skype, and he told me that he went long on GBP dollar simply because there was still much room to the upside, and GBP dollar was in uptrend from yesterday, and he actually interpreted that GBP dollar will be bullish after BOE announcement, and he made 100 pips instantly. Now it's your decision, so you can actually enter the trade or be wrong, or you can enter the trade and be right. It doesn't matter. Something will happen. You will be either wrong or right. There is no in between. In between does not exist in Forex market. You will either lose some or win some, right? So he made money. I haven't traded it. I haven't made any money. I'm looking to short into pound dollar at this point. So the thing is, it's all about how we interpret Forex market. But neither of us would have been right if there were no volatility in Forex market. So volatility actually helps us. It helps us to determine whether we are right or we are wrong, because we want to make something out of our positions. We want to trade. We don't want to sit and look at the price all day without doing anything. We want to jump in if we feel that there is opportunity and that we can make profits. But because of volatility, very often you will see that market is not going anywhere. It makes so-called whipsaw movements. Whipsaw movements actually are movements where the price goes up and down without any clear direction. This is the example. The price goes like this, and suddenly it starts to make these kind of patterns. This is dangerous. This is very volatile. You don't want to be caught into this kind of volatility. Whenever a certain market, and by market I refer to Forex currency pairs, whenever a certain market shows this kind of movement, stay out of it. It's very dangerous. It can be frustrating to trade such market because you might get into whipsaw and your account will probably end up with a margin call. What you want to do actually is try to exploit big moves advantage. So whenever a big move happens, you want to be at the correct side of the market. If there is no big move, well, then guys, definitely you know that market is probably not going anywhere, and you will probably lose a trading opportunity. So it's all about Mr. Market and whether it's good to trade or not tradable. My advice is always try to risk low if you see that market is volatile. It would be easiest for me to say, okay, I want to get rich overnight, and well, I can go with 10 lots, enter 10 lots, and well, make a nice amount of money by trading big lots. That never happens, guys. Really, that never happens. Usually we are stopped out before we even realize. So either you will exploit big moves advantage, or there will be a disadvantage because you will lose your trade. But either way, guys, volatility is our friend, because statistically, what I have read well, not just by looking at the price, but my own statistics show that volatility gives high percentage of winning but small average of profit. And that is what I have tested on different occasions on my FX book, on MT4 account statements, on my personal trades, whatever I have been actually looking for regarding volatility, it all came to this: high percentage of winning, small average of profit. Because I don't know, maybe it's our psychology. For example, when I use volatility, I usually make positions before the actual volatility. So if I want to trade volatility, it will be either a scalp or breakout trade, right? You know, guys, when market is moving fast, you will probably go with some sort of breakout trading opportunity. So because of that, my statistics show high percentage of winning but small average of profit, because when volatility is high and I go with a breakout trade, I tend to close it. It's not like intraday trade where I can keep it, or intraday or intra-week swing trade where I may keep it, or like my dollar yen trade where I might keep it for maybe, I don't know, weeks or maybe a month or two. Now this dollar yen swing. So guys, you know, it's not based on volatility. Volatility is immediate entry based on sudden price movement. You're jumping in a volatile sea. You need to know how to swim in that kind of sea. It's called like sea of madness. It's very hard for beginners. But once you master volatility, you will know when to enter, when not to enter. But I think most of the time it will be like this: high percentage of winning, but you will probably close it for a small average of profit. Well, you will close trade rather sooner than later. Now, there are different volatility indicators out there. These are my favorites: ATR, Bollinger Bands, Marubozu candles, candlestick patterns such as 3 white soldiers or 3 black crows, and master candles. So this is what I like to see. Some of these patterns are tradable, some of these patterns are not tradable. ATR, I will show it right away. ATR is my favorite volatility indicator. I really like to use ATR indicator. It actually plots different levels. It can calculate and predict the range of the movement. It's by default on every MT4 platform, but I have this custom indicator that shows much more than this normal indicator, and definitely I like to use ATR. ATR is my favorite. Then Bollinger Bands, Marubozu candles, 3 white soldiers, 3 black crows, and master candle. Before I go to and show you this Marubozu candles, but probably you know of them. If you don't know, I will of course go through it again. Let me show you the chart and ATR, what it means to use ATR. So let's say this is my, let's say, doesn't matter, dollar Swissy chart. And here I usually put 14 period in this settings here. So when you originally place your dollar Swissy, doesn't matter if it's dollar Swissy, this is just example. You can plot ATR on every chart you want. So whenever you see ATR, this ATR, you will see also these lines. There are 2 actually lines, and both of them have dots like this. So this is actually projected range, and these are pivots. Calculation for a pivot can be easily accessed by just moving your mouse cursor over these colored dashed lines. And here you will see actually, you see these are calculations for these ATR pivot points. So ATR pivots actually will plot these lines each day, and whenever high, this is dotted high and dotted low, whenever high or low are broken, you will see that these lines actually crisscross above this dotted line or below this dotted line, just taking actually low or high into matter. Whenever a high or low is broken, you will see that these lines or yellow line shifts below or above. So if you see the dollar Swissy ATR range is broken, you see it's rejecting from ATR low now. If the range is broken, then definitely these lines will be shifted okay, and this will still be projection low, but it will print out new pivot points based on this breakout. So definitely what I think is that ATR is very useful indicator, and some traders can use ATR stops. So if you use a simple ATR, for example, you can see the ATR reading of dollar Swissy is 64 pips. So when you enter the market, you can place 64 pips of a stop loss. This is how some traders do, okay? Yeah, here, for example, I will show you right now. So this is dollar Swissy. You can see it's not broken. So if we traded, let's say, dollar Swissy short from this side, we could put a stop loss or projected ATR that was 64. So here we could place 64 pip stop loss. Some people actually can use either ATR double ATR times 2 or ATR divided by 2, conservative and aggressive stop loss. If you go with ATR times 2, it will be conservative stop loss. If you divide ATR by 2, it will be aggressive stop loss. So in this example, 64 is balanced approach, 32 is aggressive stop loss, 128 pips of a stop loss is, let's say, conservative approach. So that is why I'm always saying, you don't need, guys, to think a lot about stops. Is it 100 pips? Is it 50 pips? You will calculate it by yourself. As you can see, there are different methods. Highs, lows, ATR stops. This is called volatility, also volatility stop. So the point is you need to calculate the risk. So you can put into 50 pips or 30 pips or 100 pips of stop loss, you can put 1% of risk, 10% of risk, whatever you think it's appropriate for you and your account. So it's always up to you. Leon, for example, Leon is saying that actually pound dollar is broken today. Exactly, Leon. So here you can see this was projection high, this was projection low. Because this projection high was broken, okay, here, these, you see, these two actually, they crisscrossed from above and below. So we have new pivot points. What I think is whenever something is broken with such a hard momentum, you see, this is Marubozu, guys. This is perfect Marubozu. We will come to this example. Maybe we could also use this for Marubozu setup. That is maybe a little bit different from my analysis today, but I think it will POC zone will come probably more or less the same where my analysis shows it. I'm sure about it. So you can see when this ATR top was broken, the ATR pivot just switched above. So it's not repainting. Don't think that this indicator it doesn't repaint. Actually, this is just, you see, this is just a recalculation, because this high was broken, it recalculated pivots, and they were automatically placed above and below. And when it does not happen, when pivots are respected, for example, dollar Swiss, you see, this will remain as it is. Whenever it breaks it, it will shift. So I hope that this was, now this is clear to you. Regarding ATR stops, 61 for 64 was ATR for dollar Swiss. So if we made an entry here, we would place our stop loss. If we use balanced approach, 60 pips above high, above our entry, sorry, above our entry, not above high, above our entry, 32 for aggressive approach and 128 for conservative approach. So that is how we approach ATR volatility stops. Next is actually here Marubozu candles. We already know what Marubozu candles are. If not, I will repeat. Strong bullish candle or a bully candle usually marks strong buying into support or resistance breakout. When you have a wick to the downside, it's white closing Marubozu. White opening Marubozu has a wick to the upside, and simply clear white Marubozu does not have wick on either sides. Also, we can have bearish black Marubozu, same as white, but actually this indicates volatility to the downside and momentum to the downside. So Marubozu candle, clear Marubozu, closing Marubozu, and opening Marubozu. Now this is a good example of Marubozu here. You can see clear Marubozu candle, very good. It has a wick to the upside, so definitely it's valid, guys. You can always refer to this chart. You see, very good candlestick. And how we would trade it, I would go long on my POC zone where I actually marked my analysis, where I based my analysis on. You can see it on Admiral Markets website. Now it's trying to break above it, but for example, if this doesn't break it with a high extent and it starts to retrace, definitely I would pay attention to 61.8, but more to 78.6 and 88.6. These correspond to my POC zones. But also based on my classic Marubozu candlestick teaching or high momentum volatility trading, here 61.8 could also be valid buy, especially because of this order block here. Okay, so also this could be a valid buy signal. These are also buy signals. So you see, Marubozu candles are actually volatility candles, huge volatility candles, and you can try to exploit the movement in the now moment, but it's usually done during active market session. Don't try to go with volatility based trading approach if market does not have a volatility. Master candle here, you can see master candles 1, 2, 3, 4, breakout to the upside here, and up we go. So you can see master candles are also successful in Forex trading. A lot of different examples here, 1, 2, 3, 4, 1, 2, here, breakout to the upside. 1, 2, 3, 4, okay, some sort of breakout to the upside. But you will occasionally see that from time to time master candle is not always broken immediately. The range of master candle can be very good from time to time because market tends to respect the range of master candle very often. You see here, for example, it was respected really. So master candle can really be also good guidance. For example, if pound dollar dropped here, okay, we would definitely look again into this master candle range because it marks high and low. So this is actually these are resistance and support levels. So you can always watch it as this, resistance and or support levels. Master candles are very common and they can be very strong. Heikin Ashi already covered during our webinars, but quickly I will say that it's a good trend indicator. It plots momentum. Also, because it's color coded, it will usually give you a cue for current momentum. From time to time, people tend to use Heikin Ashi smoothed. Heikin Ashi smoothed, you need to know it's also lagging indicator. So it goes with market momentum more than volatility. But there is, I will show you a concept for a system that could be developed further into volatility method because it's based purely on momentum and volatility indicators. So that is, I will present you with a concept, so you maybe would like to expand on that concept. Also, Heikin Ashi can foreshadow reversals. It needs confirmation. It's not to be traded by itself. And good an advantage to Heikin Ashi is that you can place trend lines. Okay. We will go with Heikin Ashi as soon as I finish with Arun, because then I will show you that concept for a system. Tushar Chandel developed originally a Arun indicator. Also he is the author of Chandel Momentum Indicator or Chandelier Strategy. So when the momentum in market changes from a bullish one to a bearish one and vice versa, the rune up or down will cross over each other and change sides. When the market is trending with strong momentum, the rune indicator will display extreme readings. When market is consolidating, the rune up and down lines will stay parallel to each other. So this is an example how Arun indicator looks like. It might be confusing for some traders because these lines occasionally switch, but that is how they look like. We have Arun up, that is it has blue color. Then we have Arun down that has red color. Usually it's plotted in between 0 and 100 range. Momentum usually changes from a bullish one to a bearish one, okay, and then they just flip sides and change sides. Something that can be that can be definitely easier to understand and grab the concept of is so-called Arun oscillator. And Arun oscillator is the difference between Arun up and Arun down. It can give you a strength and direction, plus 70 strong bull movement, minus 70 strong bear movement. Then we can go with minus 50 and plus 50 for direction. This Arun oscillator has red dots that are printed out when 50 and 70 or minus 50 and minus 70 are broken. Here you can see, or when the indicator goes above plus 50 or plus 70, it will plot these dots. What it means, it's not like stochastics, it's totally different. And when you see a red candle, it means a red dot, or the oscillator goes below minus 50 or below minus 70, it means that volatility is very strong and that further bearish movement is expected. Also, when it shows this green dot, we might expect volatility, we might expect bullish breakout or bullish movement in a given pair. Also, for this system or concept, we will use RSI, Arun, and we will do it on 5-minute Admiral pivot point and this Arun oscillator for overall direction. This is just a concept, guys, so it's not a complete system. Don't take it as a complete system. Here you can see we have Heikin-Ashi candles. You can leave it as they are to see complete candle if you want, but if you don't want to see it, you can just switch to line chart, right-click properties, and then here on line graph, place it to none, and you won't be seeing this line here. Just for this occasion, I will use normal candlesticks, and I will show you the possible volatility-based concept. You need to have pivot points, and you should definitely place trades at or very close to these important pivot points. For example, when you see that there is blue Heikin-Ashi, RSI trend filter is 14. This trend filter just takes RSI in calculation, and if RSI is above 14, it will be green or bullish. If it's below 14, it will be red. So blue here green, and green here dotted line above 50 is signal for a long trade. So here you see this was a signal for a long trade here, then another signal for a long trade here. So you see basically these kind of signals. You need to have volatility in markets, so during consolidation time it's not that good, but even sometimes in consolidation it can even predict future movements here. So this is a red dotted line, then this is Heikin-Ashi, but you see RSI was green. You need to have red RSI here, red, 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 everything was aligned, and here you see a drop. Okay, so this predicts movement, so it's always best used when the market is close to support or resistance. Here it's always best to be used, as I say, when it's close to support and resistance. At resistance we never buy, at support we always buy. At resistance we sell, okay, we don't buy resistance, we don't sell support. That is primary way. So by combining these indicators such as Heikin-Ashi, trend filter, and Arun oscillator, this is an interesting concept for a probable system that we could maybe work on, and that is based purely on volatility. Also, what I would advise is to watch session map, because it's very important. Admiral Market session map, you want to trade volatility exclusively during first 3 hours of London, during first 3 hours of New York session, and eventually during first 3 hours of Tokyo session. Volatility happens only within the concept of major market, usually close to major market open. So you don't want to be caught in a half trend when there is no momentum and volatility, because these kind of systems can make big whipsaws on your account if not used properly. These indicators, guys, you know what to do. Send an email to me and I will send it over to you. They are not by default. I have it, so I will send it to you. Chris will continue now. I hope that you enjoyed, guys. You learned new information. You saw new indicators. Talk to you soon. Cheers. And as always, trade safe.
Great stuff, Nenad. Thank you so much. Really appreciate that. Volatility indeed, very important to realize when and if that can happen and adjust our trading to that. Let me share my screen. I'm going to show you a useful tool for volatility, which is the volatility settings protections for macro markets. It's a special tool that you can use. You can find it on the website. And I'm going to show you the benefits of using that right now. So first of all, you can go to the website admiralmarkets.com. Let me show you. And you can click on products and you'll see volatility protection. All right, so it is basically something that helps your trading, helps you give some options, and I'm going to show you right now. You can see it as a combination with MetaTrader 4 Supreme Edition, basically. So when you click on that, you'll see this volatility protection. It explains kind of the advantages that you have with that, and when you scroll lower, it explains why volatility is important and what are the volatility protection settings, or VPS in short, and it explains the key features and how it works. So I want to basically go with you here and look at the key features and explain what they are, because there is some text, as you can see, and there's an image, and that's great. I think it explains it, but it's a bit easier if I walk you through it so you have a bit more in-depth, detailed knowledge about each of these options, really, to work with volatility protection settings. Now, in the image, you can move left and right to see how it looks without and with, so you get a visual grasp of the difference. Let's go one by one through them. Not too long, but basically you can see the idea. So basically, test it first of all. All right, anything you use, anything that's new, always good to test. And like Mario, for instance, I'm not sure if you had tested it. Probably you have. So not sure. Maybe that's good to write email about that. That could be a good idea. And see if it's something for you or not. Right? And each of these could be, some might be interesting for you, some might not be interesting for you. The first one here is basically if you say to the system, I don't want more than X amount of slippage. Let's say you don't want more than half a pip of slippage. So if there is less than half, nothing happens. The order is executed. But if there's more than half a pip, for instance, in that case, you will have a limit order instead. All right, so that's basically it. So a limit order is placed if the maximum slippage that you have predefined, is exceeded. So here you can see without, you would be basically entering at a higher price. But with this option, there would be a limit order at the price that you were aiming for with the pending order. All right. So that's useful if you are kind of like trying to defend yourself against a widening of the spread, or you see a slippage and you don't want to encounter that. So that's good for defending yourself against that. The next one is if there's a gap on one tick and price exceeds your stop, your entry, your stop, your sell stop or your buy stop, and the gap just blows, goes past that. All right. So in that case, there's a cancellation. So without it, you would be entering at a worse price. With it, the order is canceled. Okay, so that helps you with price gaps, defending against them, and not entering at worse prices. So the third one is basically pretty much similar to the first one, which said, okay, if there's a predefined slippage, right, a maximum slippage that you have in mind, but we go beyond that, the system will place a pending order, whereas the third one doesn't have a pending order, but it actually cancels it. All right, so that's the difference. So it's again about slippage, again about that predefined maximum slippage, okay? It's the same as the first one, but the first one says, okay, I'll put a pending order, but the third one says, no, I'll just cancel the order. The order is canceled. Forget the pending orders. If there's a maximum slippage exceeded, the whole order is canceled. All right, so that's the difference between the first and third. Both, you have a predefined maximum slippage. The first one, however, if it's exceeded, there will be a pending order. The third one, whole thing is canceled. All right. Then we have the fourth one, market execution of limit orders. So if there's a price spike and the market, there's no liquidity and the order is not entered, it can happen, then instead of having no order at all, there is a market execution, a market order at when basically liquidity gets back online, let's say, or returns to the market. So in that case, okay, you might not, without it, you would have no order, you would have a sell limit, of course, here, right? But there would be not activated, the order. Whereas with this, you would not have the order at the sell limit because price just was there for a second and went back, but you would have a market order at a lower, probably a lower price with the sell in this case, slightly lower price. But well, it depends. I'm not sure if it's slightly, but you would be in the market at a different price than your limit, but you would be in the market. All right, that's what it is. So without it, you wouldn't be in the market. All right, because there was no liquidity. But with it, you would be at the market, but at a worse price. How much depends on when the liquidity comes back. Okay, so that's something that is something for you to factor in, but you would be in the market though. All right, so let me double check that. If I remember correctly. Yeah, a market order is issued instead, indeed. So when the liquidity returns, market order is issued. All right, next one, reverse quotes. So this is something you want to understand properly because basically it reverses, this could be perhaps a bit confusing because it reverses, it reverses the entry and exit. So it requires a bit of a mental adjustment here. So this is something you definitely want to practice first as well. But basically, without it, if the spread widens a tad, then you might be enter at this spot on the left. Whereas if you reverse it, the widening of the spread will not have the same effect because it's waiting for the bid to go through it first. So that means that you might enter a bit later before entering the market, but you also might exit the market a bit later as well. And that's something you want to be aware of, that you might exit later, so your loss or your profit could also be affected because of that, because if the spread is a tad wider on the exit, it would also have the opposite effect. All right, so it's you might enter a bit later but also exit a bit later. So you want to test and realize that it's valid for both situations here. So that's something. It's a bit maybe complex, this one. So you want to let's say double check this, get a good experience with this and see if it's something for you. That's my point. Now, partial execution of limit orders basically, if there's not enough liquidity, not sufficient market liquidity there, then the bigger size order might not get filled. Okay, so especially if it's a limit order of a larger scale, it might not be activated if there's insufficient liquidity. Now, with this particular setting, you would partially fill the order, 50 lots, 35, then 15 lots. So it will basically be good till canceled, GTC, as you can read here. And it's executed fully if the market volume is sufficient. Otherwise, they are executed partially as the explanation here goes, with unfilled parts remaining in the market until filled or canceled. So you have that choice. You can either let it be there, let it stay there, or cancel it. And last but not least, and then we've gone through all of them already pretty fast actually, is that you can record the amount of slippage in the comment field. So that's pretty straightforward, I think, and pretty clear. All right? Nothing to add, I think, on that one. So Mario has a comment here. I'm not sure what that means. Please check point or pips on configuration. I'm not sure. Maybe Mario could give more details about that, what he means. Something in the image, perhaps? I'm not sure. So that maybe we'll see some additional comment from Mario about that. But this is something that you can find, once again, at Admiral Markets. Go to Products and go to Volatility Protection, and you'll be able to use that. All right, it's recently been added, besides the MetaTrader 4 Supreme Edition. And you can use it for your benefit. Let's see, predefine the maximum acceptable. Yes, that's here. In that way, 1 to 1,000 points. Well, I don't think 1 point is 1 pip. Probably, I'm not sure. I think that I would assume that 1 point is not 1 pip, because that's really a lot, 1,000 pips. So I would assume that 1 point is a tenth of a pip, or maybe even a hundredth of a pip. But I would most likely assume that, most logically, I think 1 point is 1/10 of a pip, which means you can go up to, or even a hundredth of a pip, which means you can go 1,000 points is 10 pips. It could be even 100 pips, but that seems quite a lot. It's possible. Either it's 10 or 100 pips. So that's something that we need to check, because I don't know. You can either check it yourself, send a message through the Admiral Markets. We can do it together. You can contact, let's see, should be somewhere, contact us. And you can change that indeed in the Traders Room account settings page. So then once you know the pip, you can write it in there. All right. So besides the volatility settings, you can also use the MetaTrader 4 Supreme Edition. There are a ton of extra things in that SE, as we've talked about before, such as mini terminal, such as trade terminal, tick chart trader, stay connected, indicator package, which I use the pivot points, for instance, and the Keltner trading simulator. So a lot of extra things to make the life of a trader, to make our life easier. Now, regarding volatility, we still have some time left. If you have any questions on that, who in here, just out of curiosity, has used that or has looked into the VPS, the volatility protection settings? Mario has, as we can see, has been looking into that. Just raise your hand. All right, that would not help because I cannot see you. Just write a yes if you have used it and a no if you have not. Just curious how many people have already tried it out. It is relatively new. It's, I think, been added a couple of months ago probably. So there's a good chance you are not aware of it as yet. So once again, the question is, who in here has used the volatility protection settings? Yes, no, YN. Okay, cool. So we got 2 yeses and 1 no. So anytime, you have a particular, anytime you use it or you haven't used it, well, maybe if you haven't used it, it doesn't make much sense. But if you have used it and you like it or you something you dislike, let me know. We always are, interested in your feedback. So you can always reach out to us and get our opinion or share your experience. We gladly collect that and gladly work on trying to make that a better product. So thanks for your feedback. Yeah, volatility. I was listening to Nenad kind of with half the ear, so I'm not sure if he already talked about it. I think he went through some indicators already. From my perspective, when I look at the market, for me, it's pretty simple. I just steer away from high news events. And this is something that's a personal preference of mine because I know that the volatility would be quite on the extreme side. Now, I know that there are traders out there that like that, want to capitalize on the price movement, and I understand that. I'm just a type of trader that, it does not do that. There have been exceptions when I am a bit more confident about a certain price movement, but on average, I steer away from, for instance, yesterday's FOMC and interest rate decision. Most of the time, I do not trade it because I like to trade more technically. I like to trade when things are not in a special news event vacuum. So I like to trade technically with fibs, waves, and during these times when it's really volatile, I noticed that my wave forecast is particularly vulnerable because sometimes it could really be that the volatility just double confirms what I'm looking at. Sometimes I could really see a total flip. So from my perspective, it is really that whole event stands on its own, and there's just a special environment where price just reacts to the expectations, the news. So it's just not a particular, that volatile, it's not so interesting for me. I like volatility, I like movement, because if the pair is too slow, like the euro pound, I don't trade it because it just doesn't move that much. So there are certain pairs I skip. Euro pound is not my favorite because of the low volatility. And this is something that is good with the market heat map that I often refer to as well. Let's go there right now. You can see what kind of movers are doing well, what kind of currency pairs are doing well, sorry. Right here, market heat map. So first you got, the top movers of the day. It shows not only currency pairs, the pound odd and pound New Zealand, but also indices and stocks. And if you scroll lower, you'll see the move versus range yesterday. And I like that a lot because it indicates volatility and it indicates price movement. I'm not sure if Nenad has talked about this already. If he did, let me know. I won't dive into it too long. Otherwise, I'll assume he didn't. But you can see that, for instance, here, if you go to the left, those are currency pairs that have little volatility. So, for instance, here, the Euro Swissy, that is on the left, relatively close to the left side. So that is low volatility. Currency pairs on the right side have shown a lot of volatility. The number one actually yesterday was pound odd. All right, that had the most volatility. And you can see that basically the range was more than 180 pips, close to 240, right? Whereas the Euro Swiss was below the 60. Now the 1% and minus 1% is trending direction. So pound New Zealand had a lot of volatility because it was, between the 180 and the 240. But it didn't go anywhere. It hangs around, or it was around the 0%. The open and close, not much difference. So it made a lot of ups and downs throughout the trading day, but ultimately didn't go anywhere. It just closed and opened and closed around the same level. All right, so could have been some good trades, but ultimately no direction. That was different with the pound odd because it had a lot of volatility, but it also closed bearish, almost 1%, which is a decent directional move to the downside. All right, so pound odd not only had a lot of volatility, but also had a pretty good movement to the downside. Now, if we look at, for instance, others, odd USD had less volatility than the pound New Zealand and pound odd because it's below the 180, but it had more directional movement. It had a lot of upside. It had more than 1%, way more than 1%. So that is basically how you can read this map. So what I like to look at is a combination of movement and volatility, because if there's movement below volatility, it's still not that very interesting. The best is movement and volatility. So odd USD, pound USD, New Zealand USD, Euro USD, dollar Swiss, dollar yen, dollar CAD, Euro odd, pound odd. All of those showed good volatility and good movement. So those are, those from a volatility point of view, I think are good, interesting pairs to keep an eye on. So this is how, you can kind of filter out some pairs that are interesting or not interesting. Whereas if you look at these pairs, not much volatility, little movement. I mean, not New Zealand CAD, Swiss yen, pound Swissy, Euro yen, Euro pound, New Zealand yen, New Zealand Swissy, CAD Swissy, Euro Swissy. They didn't have much direction. They were about the zero, plus the volatility for some of them was below 60, others was around 100. Not that bad, but low compared to the others we just mentioned. So relatively less interesting. So I like this. I used to start the live webinars by looking at this graph all the time. And I might reintroduce that actually as we go, because I didn't do that for the last while. But it's an interesting way to get a grasp about what kind of currency pairs are big movers. And you can also then scroll lower and take a look at the currency ranges. Often pound is number one. And again, today was number one. The dollar has been on the low side, but today close second, third New Zealand, typically Swissy on the lower side indeed. So yeah, Euro pound, Swiss franc often on the lower end. Volatility is also going to change and be different depending on trading times. There's an article coming up this Sunday on trading times. Take a look at the blog. Details about when the market moves more, which currency pairs move more, in which session. The volatility also depends on the timing. 19th of March, this Sunday, there will be an article on that. So these are things to keep an eye on. What currency pair, what is the heat map showing? Because typically that will give us an idea about continuation. Not always, of course, but there's a better chance that the pound USD will move more than the Euro pound. That's always like that, but especially if you see a heat map like this. So certain currency pairs are bigger movers generally, right? Pound yen, I'm sure Nenad talked about that. Euro yen, those tend to move more often. But if there is a trend, then there is even a better chance, right? Like the odd USD is not typically a big mover, but this time it did. Pound yen is often a big mover, right? But this time it was less than the pound odd. So you have historical averages. Pound yen is on the high side, but from day to day it could vary. And yesterday was on the higher side, but not in the top 5, because top 5, we had other pairs, in fact. It was lower than all of these, volatility-wise. Typically, pound yen is going to be in the top 5, but it's not a guarantee that it's in the top 5 each and every single day. So pound yen was still a good mover, but there were other pairs that were better. So Typically, some pairs are going to do more volatility than others, but it also depends on the market structure, depends on the momentum and trend that's going on, and in some cases, other pairs could, show more movement than the pound yen. So on average, yes, pound yen is going to be in the top a lot, many times. But it's good to keep an eye on the market structure and see if that sometimes is going to change. And the euro pound can also sometimes be more of a mover than today, right? Typically, on average, it's going to be on the lower end, though. But it also has its season, its time of the year when it will move a bit more. But on average, the euro Swissy, the euro pound, those are not the biggest movers. So they'll be often on the lower end of the volatility range. That also depends on when you look at the currency pair. As I just said, what part of the day. Pound yen is going to move often in the Asian session, as the article is going to show on Sunday, right? Euro pound is not going to move much in the euro session, in the Asian session. But it actually, some pairs move more in the New York or London session, like dollar pairs, right? Even pound yen moves more in the London session. But relatively, pound yen moves the most compared to other currency pairs in the Asian. So, yeah, market structure, trend, volatility, momentum, let's say that the momentum of the volatility, the historical average of a currency pair, trading times, all of that has impact on what we could expect. News events, of course, if the euro or the pound has a news event, there's going to be more movement on the euro or the pound. Or if the dollar has a news event, there's going to be more movement on the dollar. Yesterday, big news event, of course, interest rate hike, pretty big volatility there, pretty big movement. What else? Well, I mean, obviously it also depends on the market structure. You can look at the historical spot of the currency pairs. So if you look at the euro dollar, here there was a good trend and here there was a sideways move. So could there be good volatility in that sideways move? Yeah, we're looking at a weekly chart. So certainly there could, but all in all, it is in a larger correction. And there are trends on all kinds of time frames. So, this is something that doesn't mean that there can be volatility in this particular part, because we're looking especially for an intraday trader or intra-week trader. But it's something to understand and be aware of as well. What else? Oh yeah, the Keltner band basically will indicate, or the Bollinger Band, some of that volatility as it expands or has angle. Now the Bollinger Band will expand. I'll show you. First this Keltner though. Basically, if there is a trend, it will have an angle. If it's more of a sideways movement, it will go flat. And it will basically either break or bounce at the Keltner. So if it reaches the Keltner extreme, the top or the bottom, then that's a good way of knowing that it has reached kind of an extreme, in a way, in a certain support of resistance technically, but also maybe from a volatility point of view. Other good thing, of course, is the Bollinger Band. Let me show you. As it balloons like this, volatility is increasing. If it contracts, volatility is going down. Other thing you can look at, of course, I think then we probably mentioned it, average true range, and you can see if this is going up, more range, a bigger range. If this is going down, the range is slowing down. It's becoming smaller. So those are a few things that I look at. I'm sure there are many other things, but those are the things I keep in mind at least. Nenad also showed some of his indicators, so that's great. There is one question, sorry, I didn't see it so far. Is MACD showing a divergence for the dollar yen? And let's take a look. Which time frame are you looking at? Probably the 50-minute chart, I think. So in a 50-minute chart, there's definitely divergence between the bottoms. And yeah, I think there's a good chance of a bounce because of that. $61.8, not breaking through it. These wicks still not broken. So the low of those wicks, I should say. 1 hour chart is not showing divergence because the oscillator has not gone back to the zero line. Not the diagonal oscillator, at least. This is so-called bad divergence because the oscillator has not returned to the zero line, which means that this is still one piece of price action to the downside. On the Osmo oscillator, it is divergence, but it is a 50-minute divergence. Because in that case, you can see the oscillator has returned, has fully gone back to the zero line, and we have a lower low. And the lower low on price is not confirmed on the oscillator. The oscillator has a higher low. With the MACD, I need to check that. It could look different indeed. MACD 50-minute chart is also divergence. The 1 hour shows the same. So yes, it is divergence. It's not full divergence on the hourly chart though. It's a bad divergence because of the fact that this hump here is still below the zero line and it hasn't reached the zero line. Once it does that, and the next lower low is not backed by the oscillator, then we have proper divergence on the hourly. Now, don't get me wrong, you don't necessarily need divergence for a reversal to happen. It's just one of the factors. This could still be a correction and it could still end here. Of course, it is pleasant to have divergence when looking for reversals, but it also depends on the total market structure. And from my perspective, there is a decent chance that the 61.8 fib will be a bouncing spot, despite the fact that an hourly is not showing full-fledged divergence, but the 50-minute chart is. All right. So if that's not clear, feel free to take a look at our webinars on divergence as well. I'm sure there's a full-fledged explanation of that. Next week, I'm looking forward to see you again, hopefully with us. We're going to be talking about a lot of topics, breakouts and bounces, and then it's live webinars on weekly recap and his live trading sessions as well. I got strategy on Wednesday, intraday trading on Tuesday, and next week, Thursday, we take a look at intraday and scalping trading methods. So I'm sure that you'll find that interesting. That's the same time, same place, but 1 week later. Thanks again for joining and wish you, above all, great trading. Cheers.